All right, traders, how are you? It's BA coming to you on a Sunday night here at December 16th, 2018 with your nightly TTB report. And let's go ahead and get started. Take a look and see how the markets are doing. So we've got the S&Ps. Even though it shows that they're down, they're actually rallying off of the open a little bit. So we've got them up maybe about 3 points off of the open for the Sunday night session. We're going to do a couple of things tonight. I got absolutely no recommendations for tomorrow, but I want to take you through tonight just some of the levels, some of the models I'm looking at. We'll try to stay as positive as I can be because I still believe in my theory that we're going to see one of the biggest rallies yet coming out of this market. It's just ugly right now, and if you haven't had a chance, go to the blog on the website. Did a good write-up on the things that are troubling the market right now. Top 3 things, what it's going to take to move past those, and why this coming week could potentially be the most important week of the year and going into next year. So it's potentially a big week this week. And that reason for that is the FOMC announcement. So depending on what their outlook is, what they do, could hand us a big rally or could drive this market right into the grave. With everything else that's going on, this market cannot handle much more bad news. All right, so what we have here is we've got the SPX. I'm using the SPX instead of S&P 500 futures simply because I want to show you the levels going back to February here. So just look at this line right here, how much action is taking place around this level. Somewhere around the 25.90 range. It's just unbelievable at how much action, what's attracted to that right there. So let's extend this to the left. Yes, where it ran in and finally broke out above that level, and that's what lifted it up right there. So guys, this year this market came out of the correction somewhere around July time frame. So you had July through September where there was some decent activity going up in the stock market, but individual stocks were getting killed. It was one of the most bifurcated market moves in the history of the stock market. This move up right here was making record new lows every day in individual stocks, while the stock market indices were making record high or moving to record highs. So again, one of the most bifurcated markets. That's actually called the Titanic syndrome, and there were more clusters of Titanic syndrome recordings in this period than at any time in history, and those typically always precede at least a 10% pullback. Right in here, we were in one of the blogs. I went back and looked, and I said, hey, we are set up to get at least a 5, maybe a 10% pullback, and that would be the buying opportunity of the generation. Boy, was I wrong. Let's 10% down in this thing, and here we are stuck for 3 months in the same crap we were stuck in back in here. So it's same story, same issues. Top 3 things holding this market right now, of course, is the China trade deal. That's just put a damper on this market for over 10 months now. That's first thing. Second thing is fear of a recession and rising interest rates. That's not a big deal because that happens at this stage of the game all the time. I've got a really good article I'm going to show you, flash up so you can take a look at it. Guy is saying the same thing I am, a much better analyst than I am, but he's When it comes to watching for recessions, he's watching the same stuff we are. He understands the relationship, and he's saying the same thing I am. So, and what I'm saying is we still have room for a huge rally in this market, no matter what. And I will tell you, this looks as bleak as anything I have ever seen in my life. When it comes to market shenanigans by the administration. But I still believe that the market's going to do what the market's intent on doing. It's going to power through this crap, just like it always does. And it's going to hand us what we're looking for. So you just got to still stay in the game, try to stay sharp, and get ready for the moves. Now, if we cannot get above this level right here, guys, these levels right here in the SPX are, I think they're going to get hit without any trouble. So, this 2420 area down in here, I think is, if bad news comes out from the Fed, I think we're going to make a very quick trip down in there. Probably finish up the absolute. We got the worst start to a December ever. I mean, it wouldn't take much for this December to finish up worst December ever recorded in the history of the markets. But there's a chance this week it could get redeemed by dovish comments from the Fed. So it's just the market we're in right now, guys. And I'm feeling that once all of this layers of concern, once the market digests this, prices it in, it's going to move. It's going to move forward rapidly. Okay, so that's a crucial level. We'll see if we can get through that tomorrow, guys. I hope we do, man. I hope it doesn't break ranks and come back down through this level and test this area in here early part of this week. But it's possible. So that's a key crucial level in the S&P 500 right there. All right. Let's take a look at what I'm really looking at, which is telling me that longer term, my thesis is going to play out. This is a site, I'm not really supposed to be showing this. I only have this guy's permission to do this on, like, say, one model, just maybe once every couple of months. But I'm going to show you this stuff because we're in just such a quagmire right now, and I want you to see what I'm looking at. All right, there's a whole host of models here. I have top tier and mid tier models that I look at, but I'm going to show you most of these really quickly. Not going to explain them, just going to show you what I'm looking at, just so you'll know long term why I think we can still rally. Okay, this is smart money, dumb money, confidence spread. Again, no explanation, just when it gets above this green line right here, markets are in dire straits, but those are the times to buy. So look, every time it gets above right there, buy. Every time it gets, look where it made its peak right in there, right close to the bottom. All right, just add positions in there. Look when it cycled back up again, it was in that trough. Look where we're at now, guys. We're in buy mode. Okay, let's go to another model. Percent of these models showing excess optimism, pessimism spread. Every time this model gets below this green line, it's a buy. So they're all telling you the same thing. Look, see where it gets below it right in there. You see it didn't, these things are calculated differently. When they all come together, most of these things come together, guys. You just got to close your eyes, hold your nose, and just get in there. And that's where we're at right now. Look at where we're at. We're way below it right there. Not that we can't go lower, but hey, it's telling you down the road. And these things are usually good for about 3 months out. 3 months out is a safe bet that markets are going to be higher. We started putting our January positions on right in here. That's just what was keying me into January, was this. But now we've bounced up and come back down, so nothing you can do about that. All right, risk levels, medium term. All right, every time we peg the bottom here and then the market goes lower and this thing doesn't peg, it's a buy signal. So we pegged it, we went lower, but this did not. So we ripped up. Okay, we pegged the bottom here, market goes lower, the indicator does not. So it's time to add the positions, guys, or stay with what we have. Oh, let me see. I'm just trying to see what I want to show you here. This is what I was telling you earlier, that the Hindenburg omen, it flashed more times. That's what these lines are telling you right here. It wasn't present anywhere back here. It was present right here at this top. Okay, and it started real early, but it were more observances of the Hindenburg omen than at any other time in the history of the markets. So forewarning, I thought when we started getting these, I thought we were in for a 5 to 10%. Again, this market's just done nothing but completely fool me every step of the way. You know, get it half right. That's about it. All right, so let's look at what I like about the McClellan Oscillator is, you know, every time it gets below, it's usually a good time to add to long positions. You can see here, every time it pings the bottom right there, it's time to buy. But one of the best signals I like in this thing is when it comes down, gets below the level, rallies up. You can see the stock market made a new low right in here, but the McClellan Oscillator did not. Look at what's happening right here, guys. Perfect play. I mean, we're set up for just a huge rip into this market right here. If we can just keep the tweet machine, if the tweet machine would just break for 2 weeks, or they'd shut Twitter down, it would be phenomenal for the markets. If we could just get through this and let the markets resolve themselves without any comments about anything. So but this is what I like about this. It's below. In this trough, we make a lower low here, but this thing does not. So this is a good setup. You don't get to see this very often, folks. So hopefully it's the market resolves this. When the markets are left to resolve themselves, we can put a lot of confidence in these models and indicators. When the market movements are manipulated and tied to administrative, political agendas, then, you know, all bets are off. So but right now we're looking if they could just back away from the market, let the markets fix things, work on some stuff behind the scenes. I think we'd be in good shape. Let's take a look at the all right, every time you see the spikes up, good time to add to the spikes down below, really good times to let's expand this out a little bit right here so you can see it. This one's hard to but you see these spikes below right here. This is a really quick and noisy indicator. So it's PutCall Ratio is all it is. So what you're doing is you're betting that the opposite is going to happen. This just measures how many puts are being bought versus calls. So it's a bet that everybody's wrong in the market, and it typically always. You can see here a huge spike, and the calls being bought, which led to a downturn. Right in here, everybody's buying puts. Wrong time, because then it starts rallying. So, it's just a very, very good contrary short-term indicator. Guys, this one's I wrote about as well. This is had one of the most bearish readings in the AAII sentiment survey since 2013. So everybody's just throwing in the towel right now. Again, in the blog I mentioned a lot of things that I'm looking at, and this is one. Again, this bodes well for higher prices down the road. I still believe my theory's intact. I will stand by that. All these models, they're not working the way they should, simply because of how the market's moving down, why the markets are moving down. So I guess that's a better way to put it. But I still think we're getting higher prices. The models say that we are. They're saying just ride this thing out. We could see something this week. Like I said, the models are in position where this market could just absolutely rip higher and surprise everybody, and that's what I think is going to happen. So I've never been so pessimistic about a market environment in all of my life. 2011 was bad. I can remember I was cursing the then president up one side and down the other every single day they rang the bell to open the market. I'd never seen anybody cause such market turmoil until this year. So and I remember watching Kudlow, and Kudlow was just giving him what for, man. I mean, every day Kudlow was just tearing into President Obama for all of the foul play that was disrupting the free market system. Well, I can tell you, Mr. Kudlow's in the thick of it this time, and I love Larry to death as far as what he brings to the marketplace and his perspective. But boy, I'll tell you, he's in the worst part of S&Ps are moving up pretty good, guys. We've got about a 10 handle movement off of the opening. That's good, very promising. Okay, so medium term. Let's go to the VIX term structure here. Again, guys, every time it spikes above, this is time when you want to bet that the market is going to go higher. So again, you just don't question these things. We get duped in an area like this. It should never have unfolded like this. It should never have unfolded like this. But it did. But every time this thing, and look, guys, the market's getting lower, and these are making lower highs. So we got this huge divergence in a majority of these things right here that really, really tell you that it's things winding up. I mean, look at the divergence. This doesn't happen very often. This one was back in 16. We made market made a low there, high. Market made a lower low there, a lower high here. Same thing it's doing right back here. Okay, so again, as I said, I've never been so pessimistic about an environment, but I've never been more optimistic about my call that the market is just going to scream higher. So regardless of what everybody's fears are about inversion and yield curve and all these things, guys, it's just, we're way too early. This market's got way too much juice left in it to turn it around right now. Let me see if there's anything else. Alright, no, it doesn't tell me anything there. Okay, so let's see. I think there was one other thing I wanted to show you here. Zach's Investment runs some really good research. I like looking at what Mitch here has to say. He's telling you the same thing I am, and that is it is critical to note that past recessions saw inverted yield curves accompanied by a variety of other negative economic signals. That's exactly what I'm looking for, guys. I'm looking for my top tier to tell me that we're moved into danger zone. My top tier is the 10-year minus 2-year Treasury yield, looking for that yield curve inversion, and then a move back up. All right. Second thing I'm looking for is I need to see LIBOR rates close to 5 or above 5%. I want to see the unemployment, the weekly jobless claims start spiking up, and then what I want to see is margin debt go from an all-time high to start moving back down. Those are some of the signals that are present at every major crash and recession. So then once I look at those, then there's like 10 to 14 other models I look at. And then, once everything starts corroborating itself, that's when we start putting on the insurance trades. That's when we start prepping for the big one. So right here, Mitch is telling you to, hey, again, he's seeing what I see, and that is everybody's calling for a recession and that the yield curve's inverting. But he says here, I believe there are problems with jumping to such a conclusion so quickly. First is that the period of time between a yield curve inversion and a subsequent recession has typically been fairly significant, 14 to 34 months. I mean, where have you heard that before? I've shown you graph after graph of why the yield curve inversion doesn't mean we're going into a recession as soon as it inverts. Okay, history will tell you, if anybody would just look at when the yield curve inverts versus when we have recessions, you would see that there's nothing to worry about unless an event happens that's beyond our control and that could push an economy or multiple economies into a recessive state, into contraction. Now that can certainly happen, but left up to its own demise, you have plenty of time between a yield curve inversion and a recession. And look at what he says here. I've said this before too. More importantly, stocks have historically gone up 15 to 16% on average in the 18 months following a yield curve inversion, underscoring the fallacy of using yield curve inversion alone as a rationale for going defensive. He's outlining everything, guys. He's using the same playbook I am. I mean, guys that have been around that look at this objectively understand that it's a fool's game to try to call for a recession this early in the market. Now, I will tell you, if this trade war thing keeps getting more aggressive, then the president's going to push this. He's going to cause the contraction in two of the biggest economies in the world, which is going to push everybody into a recession. And that's what traders are the most worried about right now, is the intentional nudging of the economy into a recession because of stubbornness. And so that's what they're trying to price into the stock market right now. That's my opinion. But it looks like there's other people that have the same thought process. So anyway, I just wanted to show you that, let you know that, yeah, I'm just not swinging this stuff. You don't even need to be smart about this, guys. You can pull up the same data I look at to come to the same conclusions. So you don't have to listen to what I say or what anybody else says. It's open forum, open public. You just got to punch in some signals and pull the Fred data up for anything that you want to see. And it's there. You can't lie about the past recessions. And the Fred data charts show you, they gray shade the areas where the recessions are, so you don't have to guess about what happens. I mean, it's just funny. So we have a lot of room to go in this market here, and for our thesis to play out. Guys, listen, I'm not gonna put any trades on, any recommendations out. I had a couple of things that looked really good for tomorrow, both long and short, but I think we're really at a powder keg moment in this market. It's come to this week. I think it's potentially big. I'm riding in with what I have, win, lose, or draw. I'm up and I should be grateful. I'm up 24% right now in my trading account. Been up over 90% twice, and this year, but just could not out trade the old tweet machine. So we still have time left in this month here. A week and a half is a lot of time in a blow-off move. If we could get the move to the upside, we could make some shekels before 31 December rolls around. So anyway, that's kind of what I'm looking at. I will keep you posted as we move forward. I may put a trade on going into the FOMC announcement on Wednesday. I've just got to look to see how much IV's pumped into the market. So anyway, until tomorrow night, guys, this is BA signing out.